It has been on IT, the spotlight has been on Persistent, on Coforge, and on Infosys. What exactly transpired, Reema?
Well, first, let's look at the way the stocks have corrected, right? It's a very, very sharp decline, not just a mild pullback or profit booking. This is a correction, 7-8% gone on the benchmark IT companies. Now, there is no problem with growth. Growth has beaten expectation. Growth is very strong across the board. For Infi, 2.6%. For Coforge, it's about 8%. Persistent, 3.3%. The management commentary on growth is also very strong. Coforge, for instance, saying that H2 is going to be materially better than H1. Persistent also talking about how, the aspiration of $2 billion revenue top line is very much intact. So then why are the stocks correcting? Let's talk about Infosys. Here, the only reason could be that the upper end of the organic guidance has been trimmed by 40 basis points. Let me explain that. The current guidance, the previous guidance was 0 to 3%. Now the guidance stands at 1 to 3%. So the upper end has remained unchanged at 3%. That's the max in terms of growth. The earlier guidance didn't include acquisition benefit of 40 basis points. The current guidance did. So basically, 3 months back, the best case organic growth was 3% for this year. Now it will be 2.6% because the balance will come from acquisition. That could be the disappointment when it comes to Infosys. Now, when it comes to Coforge, it could be on two folds. One, on margins, and two, on their capex. Now, the company has said that their margins are at 13.2%. unchanged quarter on quarter, and they're on track to achieve 14% margins. But I spoke to a lot of analysts, and they're saying this 13.2% margin includes a lot of one-offs that the company has done. So, for instance, there is a bonus issue, ESOP cost, there would be the Forex element to that. If you strip that out, then the margins are actually a lot lower. It differs. Different analysts are putting it, at different numbers. But the adjusted, the margins X of all the one-time adjustments that the company has done is actually a lot lower. Also, secondly, this capex spend, right? On an aggregate, the company has done a capex spend of $85 million. But it includes about a $65 million capex spend for a data center, which they will be using for their clients. Historically, IT companies have never put in any capex. This was a very asset-light business. The only expense that they had was their employee. They used to provide services. But now they're investing in capex also, right? So there will be the depreciation cost. So, analysts are a bit puzzled and they're questioning. Why? Because the costs of running a data center are also fairly high. And that has also resulted in the cash flows being on the negative side. Now, Persistent, that's the third one. Here, maybe you can quibble on the growth because 3.3% falls short of the CNBC-TV18 poll. Plus, the wage hike has been deferred by 1 quarter. And third, the deal wins are strong, sustaining about $500 million. But if you have to find a reason, you can say the deal wins have not expanded. They have been in a similar range. And finally, to top it all, both Persistent and Coforge are the best performing IT stocks, most expensive, trading at about 40 times forward multiples. So that is, of course, doesn't help.
Makes sense, right? And right now, market